Many individuals all across the world are interested in cryptocurrencies. They are some of the most popular financial products in the current digital age. People who do not understand how to deal with cryptocurrencies may experience severe financial difficulties. As a result, understanding the hazards of cryptocurrency staking is critical. Welcome to Crypto Inquiry, where we are dedicated to providing you, the investor, and the crypto curious with factual information and topics. Our goal is to keep you informed to make educated and timely decisions and remove the fog of hidden information. Nothing is meant as financial advice, and always do your own research before investing. Here we are building a community to help each other stay informed and make the most of our financial gains. Staking cryptocurrencies has grown in popularity as a way to make money from investments in the markets for crypto assets. One must be aware that staking does, however, pose risks, just like other investment strategies do. The risks of staking Bitcoin are thoroughly explained. Keeping in mind, not just one, but 11 reasons can be a cause of your financial difficulties. We'll start with the easy one, since the last three might give you goosebumps. We may also learn more about how cryptocurrencies are staked. Market risk. The potential price fluctuations of the products they stake are among the most concerning prospects for cryptocurrency users. You may receive a 15% yearly return on Bitcoin if you stake it. You will, however, most probably lose money if the value of the cryptocurrency falls by half during the year. As a result, market risk is one of the most obvious risks associated with staking cryptocurrencies, and investors must choose which assets to stake intelligently. Staking pool saturation. There's also a chance you'll get a lower payout than you expected, since others have staked as well, which is frequent when a cryptocurrency gets popular. You may reduce this risk, though, by acquiring exact information about the projected reward and the number of people betting. This may be considered one of the downsides of staking MEX. Lockup period. The lockup time is the most important access among the risks of Bitcoin staking for obvious reasons. When cryptocurrencies are at risk, they are marked as locked. Some cryptocurrencies have lockup periods where you are unable to access your staked assets. Cosmos and Tron are two rather well-known currencies. Investors will be unable to remove their staked assets in the event of a major drop in prices. As a result, total returns may suffer large losses. You might try to reduce the danger of lockup by purchasing cryptocurrencies that do not have a lockout period. Validator errors. While being a crypto validator is a low-stress profession, there are still opportunities for a validator to make errors and cause problems due to their platform of choice. While you can pool your money, becoming an individual staker and hence a validator or node gives a higher total income. As a result, many people choose to wager on their own. Liquidity risk. Volatility and liquidity are other important factors to consider while staking Bitcoin. Another significant risk associated with staking cryptocurrencies is the asset's liquidity. You also do not influence market fluctuations. This is a significant drawback since volatility in the Bitcoin market cannot be avoided. If you're staking assets on many exchanges with limited liquidity, it's likely that moving the item or transferring the staking winnings to different currencies would be problematic. To ease liquidity issues, stakeholders may choose to safeguard cash assets on exchanges with larger transaction volumes. Validator costs. Using a third-party source to validate entails additional expenditures. To function as a thorough validator in proof of stake, you'll need hardware for the running node as well as the requisite number of tokens, both of which are expensive. The validator staking gains are offset by operating costs. Validators are in charge of overseeing protocol administration and defining the performance of the network. Users may then select the right validators based on their level of confidence and the number of incentives supplied. You'll need a lot of hardware and power to run your validator node. As a result, it's critical to keep an eye on validator rates and fees and modify stakes as necessary. Impermanent loss. Impermanent loss is a regular symptom of crypto staking, and it threatens the entire crypto industry. Because the cryptocurrency market is very volatile by nature, the value of tokens can move substantially in hours. This might be a problem if you're staking a coin and its value drops drastically during the staking period. As a staker, you have just become a liquidity provider since you provide a platform with available crypto money and therefore liquidity. If the worth of your staked token falls, you might lose a lot of money. This danger is reduced when you stake a virtual currency because it is bundled and doesn't suffer major increases or declines in value. Although trading expenses might minimize monetary losses, it is nevertheless a genuine risk that thousands of people confront every month. Rewards duration. Another important risk factor for investors is the period of dividends, which is also a vital component among locking periods for staking cryptocurrencies. Because certain staking symmetric encryption does not provide daily staking incentives, investors must wait significantly longer for their payouts. Although the APY remains the same, reinvest your staking earnings for a higher payout. To address the issue of long reward periods, investors may use digital currencies for staking that offer continuous staking returns. Validator risks. Staking coins involves the risk of a validation node failure due to operations for Bitcoin staking that need specialist understanding. Validators are nodes that validate transactions, and to optimize rewards, a validator must be completely operational at all times. Validators must maintain a minimum level of uptime to deliver greater staking incentives by avoiding large staking disruptions. Furthermore, improper behavior on the part of a validation node may have an impact on investor staking revenue. Worse, validator stakes may quickly reduce or slash, resulting in the closure of a portion of their piled coins. You may lessen your stake-related crypto risks by using services. A source of danger is the validator network itself. Validator nodes run specialized software that allows them to validate network transactions. They are paid once every 24 hours or, in certain networks, once every 7 days for their labor. Another hazard also includes hackers targeting validators, causing everyone who bets through them to lose money. This implies that everyone who intends to run a node has an incentive to make their node work harder or, at the very least, complete more work than other nodes. One node will eventually surpass others and generate more fees than its clients can afford if it is driven to work harder than the others. Because of this, nodes may front-run the transactions of other nodes without thinking of the potential consequences for clients in the long term. One of the most difficult issues for crypto staking is a bad actor becoming a validator for a coin. The stakes are significant because a malicious entity gaining control will begin to influence the market and staked currency. Loss or theft of assets. Cryptocurrencies, like any other asset, are prone to disasters such as loss or theft. You should be conscious that the risks of staking cryptocurrency with the possibility of memory loss are magnified in the event of loss or robbery. In rare circumstances, insufficient crypto asset security measures may result in theft and loss. Create a backup of your wallet irrespective of how you're staking cryptocurrency. Furthermore, you should make certain that your crypto assets are kept safe and that your private keys are kept secure. As a result, individuals prefer centralized third-party staking platforms over mobile apps that allow them control over their private keys. Project failure. If the development team fails to fulfill its deadlines or abandons the space, your token will be useless. If the initiative generates additional currencies, the value of your token may diminish. Many blockchain ventures are in their early stages, and even the most promising ones may fail. A project may fail for a variety of reasons, including regulatory changes, competition, or simply bad luck. This can diminish the value of your staked currency and cause you to lose your whole investment. This has been the most obvious risk of cryptocurrency staking, although it is not insurmountable. You may lessen this risk by researching the company and its management group before investing. That's a wrap for this video. Check out the videos on the screen if you're interested. Let us know in the comments below if the pros of staking outweigh the cons. If you enjoyed this video, give this a big thumbs up. And do not forget to subscribe to our channel if you want to see more videos like these. See you next time.